The market narrative is shifting, and investors need to pay attention. For most of the last 2 years, lower oil prices were viewed as good news because they helped reduce inflation pressure. But now the market is starting to see it differently. The thinking today is that lower oil prices could actually stimulate more demand in an economy that's already running hot. More demand means more inflation pressure, and that could force the Federal Reserve to keep interest rates higher for longer or even raise them again. We're already seeing signs of this shift. Strong CPI data, a surprisingly hot jobs market, and a more hawkish Fed have investors rethinking the outlook. At the same time, something unusual is happening beneath the surface. Companies with negative earnings continue outperforming companies that are actually profitable. That's not typically how healthy price discovery works. And here's the biggest takeaway. Since January, virtually all of the S&P 500's gains have come from just two areas: artificial intelligence and energy. Strip those sectors out, and much of the market is actually flat to negative for the year. The headline indexes look strong, but market breadth remains extremely narrow. That's why investors need to look beyond the headlines and understand what's really driving returns underneath the surface.